today we're going to discuss my worst performing dividend stock in my six-figure portfolio that makes me feel like I'm holding a bag of sand. And of course, we're talking about GEO Group, my prison real estate investment trust, in which I hold 370 shares, being down 45% year to date. In fact, they just posted earnings today where they cut the dividend. And being a highly politically focused company, the stock price has been doing nothing but going in the toilet, giving some mixed reactions from investors. So what I would like to do right now is go over those earnings, see how much the dividend got cut, see how much I'm going to lose because of this dividend cut. Then we're going to get to hear from the CEO himself on the conference call, and I'll give you my opinion on whether I'm selling, buying, or just holding. So in the clarity of my transparency, in return, I simply ask that you smash that like button. It really helps out the channel. But let's just welcome back, passive income investors alike, to the most morally controversial holding in my portfolio, which is this prison REIT. And most people are unaware that these are pretty large companies that are fairly well diversified by having not only like lifetime prisoners, but they deal with troubled youth and mentally ill, with a large diversified portfolio all over the US. I mean, I think the whole portfolio is worth about 1.3 billion today, and they have expansions going on in Europe, Australia, and Africa as well, making this seem fairly attractive, except if you look at the real estate itself, because in fact, this is probably some of the most ugliest real estate on the outside of cities, housing some of the most messed up people in the world here, folks. But the only beauty behind this is they have minimum contracts with the government that guarantees money's always going to come in, and which goes into some dividends into shareholders' pockets, giving us some of that tax money back that we pay for anyways, that goes into the prison system. So this is a very interesting company, which is why I found it so attractive in the beginning. But let's get into these earnings and see what the heck is going on. Now, even though they beat on revenue, which is fairly impressive, they are having troubles on their bottom line earnings due to the CV causing all kinds of problems in the justice system, which we're going to hear about when we listen more from the CEO. But just taking a look, with a total revenue of 587 million, which year over year is down minus 4.3%, but it beats the analyst expectations by 3.6 million, because obviously people thought there was going to be a lot worse stuff happening here. And I have to say that analysts actually got this pretty close, just considering the economic circumstances we're in. Now, the thing that really floored investors, of course, was the dividend cut. GEO Group drops by 6.6% in pre-market trading after the company said it expects a reduce in its quarterly dividend to 34 cents from the original 48 cents per quarter. This expects to allocate 50 to 100 million in excess cash flow annually to their debt repayment. And this comes with the surrounding political issues of basically banks trying to turn their heads away from these companies and not actually finance them. Even though they are well capitalized, they are protecting themselves in the future event that they might not be able to raise capital. So they are primarily lowering their dividend to repay back debt, even though they had some pretty decent earnings here. And we can read that right here. While we do not have any upcoming debt maturities until 2022, we have announced today an anticipated reduction of our future quarterly dividend payment in order to preserve capital and focus on paying our own debt, said Chairman and CEO George C. Soley. Our anticipated new dividend payment will allow GEO to remain structured as a publicly traded REIT, thus providing continued value for our shareholders while also focusing on debt repayment, in which they are also trimming their guidance for their 2020 revenue to 2.34 billion, and they had a prior view of 2.38 billion, so not that big of a difference overall. So I did a little bit of math here, and essentially if we take their 34-cent dividend and we times it by the 4 quarters, we're going to end up with an annual dividend of $1.35. And if we divide that out by a percentage basis, presuming the stock hovers around $11, they're going to have a basic average yield of about 12.2%, which is a massive reduction from the 17 to 18% they were currently trading at. And if we go take a look at my personal position here of my 370 shares, they were currently paying me about $710 in US dividends annually, in which that is now going to be reduced. If we take that $1.36 annual dividend, times it out by my 370 shares, we can see that my annual dividend drops to about $503, or a reduction of just over $200, which yes hurts, but don't worry, I'm going to comment on my personal opinions toward the end of this video. But let's get into the balance sheet and just show you some quick highlights before we listen to the CEO himself here, folks. So if we head on over to GEO Group's website and we head on over into the investor relation page, we can open up their most recent presentation. And taking a look at their portfolio overview of their different income structures, the most incredible thing behind this is looking at the occupancy rating, in which we can see on their owned and leased secure services is down by 10%. And the reason that if we go through all of these, taking a look at owned and leased community-based occupancies are also down by more than 10%. We can see the owned and leased youth services, so where they deal with children, is down by just under 10%. And then we can see managed only occupancy is just down by 1%. And the reason occupancy is down so much is obviously because of this pandemic. They shut down the entire justice system for like an entire month. Nobody was getting court cases done. And then on top of that, they had to obviously release some prisoners, in which we can see down here when we go into the non-residential units, they have a bioelectronics and location monitoring, which we can see from 2020 has increased massively. Which we can see from Q2 of 2019 was roughly 20,039,000 people, which has increased to 20,694,000, which is an increase of over 500,000 people are now basically on house arrest. And if we take a look at the year over year, we can see basically for the first 6 months end of 2019, it was roughly 39 million, in which it has increased to 40 million. So we can see for Q2 of 2020, the total revenues, which they mentioned, was 587 million against Q2 of 2019 when they did 613 million. But when we take a look at the total operating income, guys, we can see it's down pretty substantially overall from 81 million in Q2 of 2019 to 63 million, where it currently sits today. Now, this also has to do with the fact of increased spending on getting basically facilities up to code. They were obviously having issues with the CV virus spreading amongst some of the prisons, which they had to deal with, so they had to make everything safe and secure. And this comes to with every company. It is just a sign of the times. I mean, Pepsi had to do it. We saw it with Apple, with Microsoft. Every company is spending a lot of excess revenues right now just to keep things clean and keep things up to basically health code standards. But what I would like to do right now, before I give you my personal opinion on whether I'm buying, holding, or plan on selling this company, let's just take a quick listen from the CEO.
Despite the significant challenges associated with this global pandemic, we believe that our business, earnings, and cash flows remain strong. We believe that our business is underpinned by long-term real estate assets that are supported by high-quality contracts for the provision of essential government services. We do recognize, however, that the current political rhetoric and mischaracterization of our role as a government services provider has had a negative impact on our valuation and has created concerns regarding our future access to capital. While we don't have any upcoming debt maturities until 2022, we recognize the importance of capital preservation and debt repayment given the current environment. To this end, our board of directors and our management team have determined that it would be in the best interest of our company and shareholders to reduce our quarterly dividend payments and apply our excess cash flows to pay down debt.
Our guidance continues to assume lower occupancy levels for our GEO reentry facilities and programs through the end of the year, resulting in an estimated revenue decline of approximately 10% for the full year. Our youth services segment has also been impacted by declining occupancy levels and the expected closure of the Hector Garza facility in Texas at the end of September as a result of the pandemic. We have also increased our spending on personal protective equipment, diagnostic testing, medical expenses, non-contact infrared thermometers, and increased sanitation as a result of COVID-19, and expect to incur several $1 million in non-recurring costs during the second half of 2020. Our updated guidance continues to assume no contribution from our Central Valley, Desert View, and Golden State facilities in California, even though we remain hopeful to be able to activate these facilities as ICE processing center annexes beginning as early as late third quarter or early fourth quarter of this year. Despite these challenges, we believe that our revenues and cash flows remain strong.
Okay, thank you for that. Now, on the dividend, did you guys reduce that to basically the lowest level that you can and still, qualify under the REIT, or is there still additional room that you could have lowered it even further?
No, there's still additional room. I think we looked at it from the perspective of we wanted to, as George mentioned, maintain the REIT status and continue to return a valuable amount to the shareholders, but also focusing on paying down a meaningful amount of debt. And I think that's the sort of balance, or the point where we found that proper balance.
So this is one that I am not recommending people buy. You have to have a special kind of moral fortitude, along with having a very moral grounding on watching the volatility in a company like this. And now that they're going to be paying out roughly a 12% yield, it seems a little bit more reasonable. And it's something they're saying is going to be sustainable for the long term. So I'm going to be happy holding on to it, still collecting that really healthy yield. And because the core underlying fundamentals of the business haven't really changed, as an investor, I can't really change my bull thesis behind this. I think like many REITs out there, like if you're buying RioCan, another favorite of mine, or whether you're looking at something like an O Realty Income, I think you're really going to have to sit tight for the next year until we can ride through this pandemic, coming out on the next side of the year when there's likely going to be a lot more growth behind this. But because this is mainly politically based, I think once we get through the election, we should start seeing a sign of light in the stock price. But overall, earnings better than expected. Sucks there's a dividend cut. Clearly, a lot of people were holding this for the dividend. As we take a look at the stock price in this very moment, we are down 6.25%, a little bit more on the opening of the day. For the PE of 8.5, according to Google right now, I think this company, if anything, guys, sits at somewhat of a fair value territory, if not a discounted territory. But again, it comes down to your volatility risk. Can you handle the political and moral drama behind owning something like this? And I would love to know what you think in that comment section below. This is the only US REIT that I primarily hold for a few reasons surrounding some tax problems, because I have to pay withholding tax. So this really sucks. Not only am I losing $200, but every time I get paid already, I was losing 15%. Considering how great the earnings season overall has been for me, when we've been talking about MO, when we've been talking about like Apple, Microsoft, Facebook right now, guys, tech is on fire. Not all parts of my portfolio I can expect to be doing just stellar, right? So this is probably going to be the worst ding that I get. And then finally, if we can just get through some of the Canadian bank earnings coming up next week, and then I will have finally survived my first quarter ever in, I guess, what we would call a technical recession since I've been investing in these markets. And I am certainly not complaining by far here, folks. But I'm going to keep an eye out for this one, and of course I'll share updates down the road. But I can't sell when I'm down 40%, and the underlying fundamentals haven't really changed that much, all things considered, of course. But stay cool, stay awesome, and I look forward to chatting to you guys tomorrow.